Yeah, yeah, started the recording. Go ahead.
Hello everyone. Quickly, this is just a presentation or education session, not a sales pitch or not trying to see if you like if you're interested in this. Idea is to show you something which I have learned through my research, and maybe it will help you to get diversify and add into your asset class, right? Even though if you learn from here and you want to work with somebody else, that's absolutely fine. So, a quick introduction about me. My name is Andy Bhanushali. My actual name is Arvind, but because we had three people in my group, Arvind, so everybody picked the name, and I picked Andy. So this name stuck with me since the college time. So you can call me Arvind or Andy. I'm from Mumbai. Came to this country 23 years ago, and I'm a certified financial planner. So I'm a licensed in many states. I'm also MBA in finance and international business. Uh, I do help people on educating the various services in the financial. But today I'm going to focus more on the how do you secure and how do you compound your assets without taking risk. That's the topic for today. So some of the solutions we have in the like financial life goals, right? So basically, what are the financial life goals? Everybody wants high rate of return, right? Nobody says that I want low rate of return, right? So basically, the idea is to compound your asset, not just compound, but exponential compound, right? So there's a different way of compounding. Even a bank CD compounds, but we are not talking about that linear compounding. We're talking about exponential compounding. Now, there's a saying that high risk, high reward, high risk, high reward, right? So, what fun if I talk the same thing, right? So, what I'm going to focus more is no risk, high reward. And basically, when I say high reward, we will say it should beat the inflation. That is a high reward. That's a good way of, it's not going to be like filthy 50%, 60% like cryptos, but it should beat the inflation. So, at least you're getting richer and richer, right? And there are some other services we talk about, but I'm going to just focus on the ones which are marked in yellow. And as I say, it takes few more sessions for me to cover everything. But today I'm just going to focus on the ones marked in the amber or yellow. So while we are growing an asset, we also need to make sure that, according to me, the wealth accumulation is a one, but the king is the distribution. The income is the king, not just the wealth. I mean, I can get filthy rich and all my money sitting in the bank doesn't mean anything if I can't distribute it, if I can't take the income, and if I can't enjoy my life with that, right? So using the money is more powerful. So how do you then take the income out, right? So basically, is there a formula for distribution? And what I mean by here, and you guys can also put it in the chat if you're interested, but if I know my, let's say I'm retiring at 65, right? And I have say $1 million or $2 million or $5 million, right? That's a good formula. So we know how you can grow the money. But if I don't know when I'm gonna die, if I don't know how many years I'm gonna live, then how do I distribute that? Should I divide that million by 20 years, 30 years, 50 years, 40 years? I don't know. So there is an inherent risk of longevity risk. What is longevity means in this country, unfortunately, a lot of people outgrow because of the medical advances and life expectancies are high. They outgrow their money. They outlive their money, right? That's called superannuation risk or longevity risk. So we don't want that, right? We want to retire. Once we retire, we stay retired and we continue to get consistent income, what we had planned for. So these are the five topics I'm going to cover through one of the asset class, which you or me are not aware, right? While there are other strategies like tax-free retirements and tax wealth transfers and infinite banking. I'll cover that in the future sessions. I just want to make sure that we start with a very simple concept which most of you will get it, right? Okay, so wealth building gaps. Let's try to answer these questions. This is the $1 million, like these are the $3 million questions, right? So I don't need to know the answer, but you can answer it in your head, everyone. So how much of your funds are you okay to lose when the market crashes? And I can read your mind. You all are saying zero, right? You don't want to lose anything, right? At what age do you want your funds to become zero? Now, this is for the people who are in the they are in the retirement or distribution phase, right? So you have to think about how long you're going to sustain your assets. Is your nest egg going to become zero before you die, right? That's a big problem. So again, the answer is you never want your nest egg or your funds to become zero, right? That's not how we train also. We always work so hard to continue to accumulate the wealth, not to decrease the wealth. And then the last question, how much tax do you want to pay when you start the retirement or when you start the distribution? Obviously, as a good citizen, we should pay some taxes, but we want to pay as little as possible, right? As little as possible. If we all, we have worked so hard, so we want to have our share, but again, we don't want to pay too much taxes, right? So now look back your current strategies or current portfolio or asset classes you have, whether you're doing real estate, stocks, bonds, 401ks, IRAs, or anything. Is that strategy giving you some kind of an answers which helps this? Now you can actually great investor and we can do all three, right? You can actually plan all three. But if it is doing that, then you're in the right path. If not, and you're taking that, everything is opposite. Like for example, if you just have 401k fund and it's just sitting in a target fund, then none of them is possible. Like you are basically going to have eventually you need to find a distribution formula. Then you may have a risk of longevity risk, and you will be paying taxes on all your 401k. Right? So again, you have to think about how you're going to create that asset class and diversification. So these are some concepts. As I said, I'll go over this in a later sessions. Right now, this is the more of four major wealth building principles. I mean, there's a famous book. Most of you probably know this book. It's called The Richest Man in Babylon. This was a famous book. So millions of copies sold. You can read the book also, but these are the four major principles comes out of that book, right? Again, this is how the money works. This is how the wealthy people also work, right? So if you max on the first quadrant, the left quadrant, you need to maximize your growth. Basically, beat the inflation and taxes. Money sitting in a banks or cash or under the bed, it's not going to make you richer because the inflation is going to, like a termite, is going to continue to eat that, right? Compound your money. That's the major factor, right? Invest to grow. However, while we're doing it, many of us are not getting the optimal growth. Why? Because we are taking the huge risk. So ideally, you want to avoid risk. You want to minimize your risk, right? If you can time the market, perfect. You don't need any of this. But if you can't and you're late, like a market crashes and you realize it. Oh, and then market is going up and you get into late. Anyway, so minimize the risk means what? Guard your principles and guard your interest you made. And I have a lot of friends who made ton of money in 2021, but they lost all in 2022. They made again ton of money in 2023, but they are barely breaking even because of the losses in 2022. So we want to make sure we guard our principles. Your taxes should be in the right order, right? You should first get the free money and then the tax free and then the tax deferred and tax now, right? So a lot of people get the free money, which is employer contribution, right? Which is free money. And then they quickly jump to tax deferred. They start overfunding 401ks for no reasons without looking into tax free strategies. So anyway, I'll cover the taxes in some other session. And then your assets should be protected from all kinds of litigations and bankruptcies and all those. So I'll focus more on today maximizing the growth and minimizing the risk. But these are the core principles of the diversification formula. Any asset class you have, I'm not saying any asset class is good or bad, but you should look to get more of these check boxes ticked in that asset class. All right, so look at the maximizing the growth quadrant. And there's obviously everybody knows about rule of 72. If those who don't know, the rule of 72 says that you take a number 72, divide by rate of return. It tells you how many years it will take to double the money. So for example, let's say somebody is a 29 years old kid, has $100,000 invested 2%. 72 divided by 2, money doubles in 36 years. So, again, 29, 100,000 at 36 years later, which is 65. Again, the magic age of 65 used for retirement, right? Simulation. So 100 becomes 200. Okay, what if we double that? We said, okay, now you're earning 4%. The money will also double, right? So now 100,000, which was 200 earlier, have become 400. So now my question to all of you is, at 2%, 100 is 200. At 4% is 400. What will be at 8%? And again, those who are saying 800, I understand that answer also, but that's a linear compounding. What we want to look at is exponential compounding so that it's not 800, it's 1.6 million. And why is it that? Because it's a double, right? So rate of return also double, and the years, number of years also shrink, right? So now you have extra double. So now if I have to focus, there's no, it's a math, simple math. I'm not adding anything other than one thing I want to say, the last double is the key. So if you can double one extra double in your lifetime, you can have above average return. If you don't double that, you'll have average return or below average return, right? So now the $1,000,000 question is, where can you get 8% consistently and you double every 9 to 10 years, right? So what kind of asset classes will allow you to do that? So again, real estate could be good. Some people are very successful, but masses don't do that, right? So masses get like, most of the people get 5-6% if they're lucky. Stock market, again, it's a great investment vehicle, but again, there's a saying, like 95% people don't even beat S&P 500. So yeah, 5% do get like Warren Buffett, and I'm sure some people are here also very smart people. I'm not denying that, but stock market also is a good thing. So same thing, stock market, bond market, nowadays crypto, gold, foreign exchange, whatever you want to flip. So they are all good assets. But the thing is, what if they lose? So there's also, like we're talking about compounding, are we also compounding our risk? So there's also, it will actually impact when you're taking the risk, your risk will also compound. So what do I mean by that? Let's take a stock market, for example. So for example, here, I'm going to do a simple math, right? So when we watch CNBC or any, Bloomberg or any Reuters TV, we always look at the rate of return because that's what's been fed to us. So there's a rate of return and there's a real rate of return, right? So I'm going to do we'll play a simple game here. Mr. A and Mr. B both have $100 to invest. And in the following scenario, we'll see who ends up doing better. So let's say scenario number one is the stock market. Mr. A takes the risk, but he's aggressive. So first year market went up 40%, he made 40%. Next year when market went down 20%, he went down 20%. So plus 40 minus 20 is 20. Simple, right? Mr. B is a little bit conservative, but doesn't take any risk. So first year made 10, second year made 10, 20, 20 both, right? Now, obviously, this is how the media will tell you, hey, market is 20% average last 2 years. Is that true? Do they both have equal money at the end of the second year? And if you really do the math with the dollars next to that, you will see there's a difference, right? So when the first year, when the market went up 40%, Mr. A became $140, obviously. Second year, when market went down 20, there's a negative compounding happen because now he has 140 at risk. So he lost actually $28, which is actually 20% of the 140. So his real rate of return for Mr. A is not 20%, it's 12%. That's called CAGR, compound annual growth rate, or you can say geometric average, right? Again, Mr. B made extra dollar because of the compounding happened there. So that's how we want to do it. Now, again, many of us, like I'm 50, so I've seen 2008. Some of us have seen 2001. So look at 2008, 2007, what happened, right? First year market was 50% up. Even 99, right? Market was 50% up. And next year market was down 50%. So plus 50 minus 50 is 0. Mr. B did not make anything, did not lose anything. Again, 0, right? Now, again, the same formula applies. 100, first year became 150, right? And the second year, when the 50% crashed, the entire 150 became 75. So Mr. A is not a 0% loss. It's 25%. This is the reason, as I was saying earlier, many of my friends are barely break even because they lost 17-18% last year, like year before, and they made like 14-15% again. So they are just getting their barely capital. So again, when 50% goes up and 50% goes down, it's not same. It's not zero-sum game there, right? This minus 25%, right? Now, I also want to show you some crazy math here. Let's say now year 3, how much percentage market have to gain in the Mr. A's example? We are sitting at $75. How much percentage market has to gain to go back to 150 from 75?
100%.
100%, right? But you can see the irony here, market has only lost 50. So that means it requires doubles to just break even. And again, second question is how many years do you think market will take to gain back the 100%? Right? I'm not talking about 1 or 2 years, but it takes usually 4 or 5 good years to recover that 100%. So here, what I'm trying to show you is not that we are losing money. We are young, so we can wait. A lot of people believe in waiting, and they do recover money in 4 to 5 years. I understand, but they will lose the 4 to 5 years. And when you lose time, what happens? The rule of 72, that last double will not happen because we lost 4 or 5 years. And that is you in the time value of the money, right? In the stock market return, why is the time value of the money is important? The time is the first component. So we don't want to lose the time, right? The dollar today is not same as dollar, 5 years from now. So losing 5 to 7 years means you lose one compounding cycle, you get average rate of return. Let me show you some of the other steps. So now how do we fix that problem? Also, I'll show it to you. So here I'm going to introduce something called index strategy. Now, index strategy, don't confuse with ETF or indexes or any of the indexes. It is a strategy I'll explain in a second. But let's say Mr. A on the left side again. When he had $100, market went up 10% first year, you got 10%, right? And then 20% and you get 20%, and so on and so forth, right? So 100 became 145, compounding with 40% rate of return. There's no problem here. The problem is when market crashes 40%, then 145 will become 87. Now on the right side, what I'm going to show you today is an index strategy. This strategy can be sitting in various asset class, right? So here, think of this is a cap and floor, right? Strategy is a limited return. So I'm going to add a cap here purposely, say 13% cap. What is cap means? Maximum you can make is 30. You cannot go above that. Okay, that's a problem. Okay, that's a limitation on that, right? But the good thing is the floor is zero. That means you will not take a single penny of risk, right? So 13 cap, zero floor. That's the technical terms of. I call this secure compounding. So you guys can understand it simple, right? So in the secure compounding or index strategy, whatever you want to say, the same index. If this is a left side is S&P 500, right side is also S&P 500, right? So market goes 10%, you'll make 10%. Market goes 20, you're not going to make 20%. You're going to make 13 because of the cap, and so on and so forth, right? So your 100 became 137. Now the market crashes 40%. How much percentage you will lose? Nothing. Your 137 will stay at 137. Now let's look at the left side, because typically this is uptrend. 4 or 5 years market goes up, 1 year down, then starts picking up again. On the left side, market goes up 10% again. What happens to your 87? Still sitting at 96. So on the left side, 6 years or 5 years, market is in a good recovery mode and you still barely broke even. On the right side, the 10% becomes 50% higher. It's 151. So on the right, what I'm trying to convince here, left side is an unlimited return, unlimited risk, and barely breaks even. On the right side, limited return and and no risk. It is 50% up in the same market. What if I remove the cap? What if I say, okay, cap is also unlimited? Like, then obviously it will beat the right side. I'm purposely being conservative on the right side. There are strategies where you do not have a cap. You have a floor but no cap. That will also definitely beat, and the chart will go from my screen, like outside of my screen. But I'm just showing you because on internet you hear about cap. You hear sometimes somebody will say, oh, this article is a cap. Cap is not bad because we don't care about the cap. I care about the floor. So why I'm showing you this in detail is the best money, guys, we can make is the money we don't lose in the market crashes. That's the formula. Cap or no cap doesn't matter. If I change it to 10% cap, it will still work because I'm not losing money, right? So again, this is not a 1 year investment or 2 year. We're talking about long-term retirement, college funding, different mortgage or whatever you want to plan, a bigger life goals, not like next year's plan, right? So let me show you facts. That was the concept. Now you guys all know index strategy means what, right? So the blue line is that bank CD, treasury bonds, etc., etc. In 1997, somebody has 100,000. Into 2020, it barely doubled. It did not even double actually. 100,000 became 170. Now the good thing is guaranteed. But you guys know how much we were getting bank CDs at one time, like 1%. Okay, now it's high, but again, look at the inflation compared to inflation is nothing. So that's a fixed line, the blue line. That's why we all don't like the growth. That's why we all rely on the red line, which is actually S&P 500 chart. So again, somebody had 100,097, became 151 in 99, and the market crashed 3 years back to back, 2000, 2001, 2002, dot-com bubble, September 11, all those things, right? So 151 became 93. It took 4 to 5 years, as I said, it takes that much time to gain back, right? And then 2007, 2008 happened and it crashed again. Right? And then again, it took 4 years to get back to 150. If you look at the 150, 1000, which is in 2000, and look at 2012, which is also 150. Imagine this guy did recover all of his money back. So he's having the happy feeling, but he lost 12 years from his life. He lost 1.5 compounding cycles. So again, that rule of 72, the last double or two doubles for him may not happen. Right? Yes, market has gone up crazy after that. One of the best thing happened after that. Again, it has gone down, up. We don't know whether we are entering again in this kind of zones. We don't know that. But if market went up, perfect. Right? Now the green line is actually that index line. When the market goes up, it goes up. The market goes down, it locks. So it grows and locks, grows and locks. Green line never goes down. Period. Okay. So again, the question is, if and again, I'm not saying green line is beats the S&P 500. It could be same, it could be, but it's not like down like fixed. It's usually, we have seen that it's almost same. So if I eliminate the risk and I get so no risk, and if I can the stock market like performance, which is actually S&P 500, why would we not all do it? And that's the index strategy. Okay. So obviously, I usually ask questions, but I'll just skip right now because But we'll keep. So now, if you look at the last, again, you guys saw the last 20 years. Okay, again, 98 to 2017. I have the old data, but if you look at the CAGR, with the market only went down 1, 2, 3, 4, and 5 years out of 20, it has only given the S&P 500 itself is only given 5.24. Whereas if I had a cap and floor, it has given 8%. You can you can all look at the compounding calculator and see what this 2.5% will do if you just had 100,000 for 20 years. It's actually 200 to $300,000 gap. Just this 2% will create. Okay, so this is my favorite. As I said, I do ton of research. My goal is to educate, right? So here I went back. So index strategy works in the sideways market and bullish market. We saw that. I wanted to see what was the worst 20 years ever, and these are the worst 20 years I found, and I wanted to compare index strategy in that time frame. So 1929 to 1948 was one of the 2 decades worst ever. First 4 years, this called Great Depression. None of us were here, but we've read the history books. This was where 90% of the people lost jobs and everything was disaster, right? And then this is 1937, where Germany invaded Poland. That was it feels like what we are feeling right now. Some wars going on right now. That's the start of that war. And then the World War, again, market was back to back 3 years negative. And then this is nuclear bombing happened in Japan, and then the economic recovery. So if you count here all the red bubbles, it is 10 out of 20 years market was negative. And if you look at $1, which is the fourth column, $1 which was invested unprotected, it could be 401k, IRA, stock market, brokerage, whatever you want to call it, it became 20 cents on the fourth year. It did recover a little bit, but then it became 60 cents unprotected. $1 became 60 cents, 20 years lost, and 40% of assets gone. Obviously, he now will be lucky if he can even have one double, right? At the same time, if I compare the index strategy where I have floor and cap, again, I'm purposely adding a cap here. Your $1, the limited dollar in the last column, always stays as $1. Whenever market goes up, you're not going to make 66%, you're going to make 13. So what? In the same time period, if you look at your $1 became $2.88. This is the power of secure compound. You want to compound it, at the same time you don't want to take risk, right? If anybody has a question, please unmute and let me know, right? These are some of the stacks advantages, we'll cover it in next session because I'm watching the time also. I want to show you the actual illustrations rather than this theory lecture. So as I said, we have all the life goals on the left side, right? So high rate of return, I don't want to take risk, college planning, lifetime income, medical cost, taxes, liquidity, asset protection, and you could have had 10,000 other life goals. What I like to do is, do you have all the asset class? And do you know what each asset class does? So if you see bank series, they are good for protection, but they don't grow. They're good for liquidity, but they're not going to get you rich. Government bonds or real estate. And I'm not saying yes or no, but you should have all of them. I'm not saying anything is bad. But today I'm going to focus on this asset class, which is FIA, which is a fixed index annuity. So annuity, again, it's an asset class, and we are going to implement index strategy inside that annuity, so it becomes fixed index annuity, right? Obviously, there are some good insurances and other products as well. We'll talk later. But this is what today's focus, the green. And as you can see, it has most numbers of Ys, which we want to see. Okay, so let me explain the annuity a little bit. Okay, and again, I'm not here to sell you guys annuity. I'm pretty sure you guys all know about annuity, but if not, I'll just quickly explain. So what is annuity? Annuity is basically you have IRA account or 401k account like previous rollover, previous employer's 401k account. That kind of fund, or you have a money sitting in a bank, you can put it into annuity, which will generate a consistent stream of income, right? So it has all the three formulas: a contribution, accumulation, and the distribution, right? And now there are different types of annuities. So one is called fixed annuities. They are basically nothing like a bank CDs. They guaranteed. You see that blue line over there I showed earlier. They're guaranteed, but they give you 4, 5, 6% right now. Maybe some are giving 7%, but that's it. There's no growth. There's no downside. It's good for some people who are already in the retirement, maybe have some kind of money in the fixed annuities. There's a variable annuity. A variable annuity is something we need to watch for. If you look at the internet articles, and there's a ton of articles, they were favorites in 99, in 95 to 99, but they become very like horrible returns in 2000 because a lot of people thought nobody can touch this. 401k is also one kind of variable annuity because you're not going to see that money until you distribute, right? So variable annuities, the problem is, it's like the red line. Market goes up, it goes up. Market goes down, it goes down. And also the problem with variable is the huge charges, because the way they invest in some funds, and when they invest into 20 funds, all the 20 is going to charge and all those things. So again, variable annuity, try to stay away from them unless you know the internals, or unless you have somebody like me helping you, right? But as I said, the fixed index annuities are the green line. It's a fixed index, so they are not like, they are guaranteed to not go down, but the growth is based on some index. S&P 500, Nasdaq, BNP Paribas, Barclays. There's a ton of indexes, right? And they are annuities. So now it is also what is annuities? Benefit of annuities is a tax deferred vehicles. So you don't have to pay taxes as it grows. So for example, your asset becomes, let's say you have Apple stock you bought today and you sell it for a 10% growth, you're going to pay taxes. Annuities, you don't have to pay taxes until you distribute it. Now, annuities can also take a shape of any account you have. So what do you mean? What I mean by that? For example, you have IRA. Let's say you have IRA money of 100,000. You roll over into annuity, it will become IRA annuity. If you have a Roth IRA, you roll over that into annuity, it will become Roth IRA annuity. That means all the growth, all the distribution will be tax free. You have a cash, you go into, it will become cash annuity, but it will behave like traditional IRA. So many of us, we don't even qualify for traditional IRA. I mean, most of us will have 401k or something from work, so you don't qualify for it, right? So if you have a cash, there's a good way of creating the traditional IRA. There's no limit into fixed index annuity or any annuities. It'll become tax deferred breakup. So anyway, so that's something, as I said, taxes we'll discuss later. Now, we will be, as I said, our favorite is fixed index because we are trying to hit all the four quadrants, which is the growth is the main thing. Other ones, the variable annuity has risk. which we don't want. Fixed index annuities does not have growth. So we want to focus on this one, which takes care of the green line, right? Now, within fixed index annuities, there are different types of annuities. And again, this session is not about annuity, but since I'm on the topic, there are growth annuities. So basically, they grow crazy. They have a higher participation. So they have a higher multipliers. You will see that in a second when I show you the illustration. There are income annuities. They focus on the pension-like annuities. So once you, uh, somebody's trying to do annotation, I'll decline this. So income annuities are like, once you distribute the money, no matter what happens in the stock market or no matter what happens to your assets, income will never stop as long as you live. So if you remember in India also, most of us from India, right? So we have a provident fund and we have pension. Also here we have 401k and pension, government pension, right? So what is the different type? 401k is your money. You can take it out however you want when you retire. You can take it a chunk of money, or you can take it entire money, or you can take it convert it into a lifetime, like you can have a 4%, 2% rule, whatever distribution. That is your way of you take the full risk of the distribution. The pension, government pension, some of the medical professionals or some of the teachers and government employees have the pension. Or what is pension means, like a social security, right? So they guarantee once you start getting it, it'll never, like social security also is a pension type where it will never fade away. So if you really, what is social security is actually fixed annuity of income annuity type. That's how it is. Okay. And then we have bonus annuities and enhanced annuities. Okay. So, we'll come back to this one. I'm going to show you guys something, real examples. So then you can all see what this means. So,
So Andy, I had looked at some of these things before. I think there were a lot of negative factors about this. One was like heavy fees, right? Initially, and then you have a locked in, like you cannot change your mind for like 7, 10 years, right? Because then you will get only a percentage of whatever you invested in, right? Yeah, so those are some of the risks that come with like the fixed index annuities. I hope you'll be covering the
yeah, I'm
downside
going to
and what
cover
to
that.
watch out
So,
for.
correct. So then I'll also kind of give you that because you're asking the question. So there is no fees. Okay. So then yes, as I said, a lot of good, bad, ugly, whatever you want to call it. There, not everybody is giving the truth also, right? I mean, again, if I open the article, somebody will say bad about, like, Dave Ramsey, for example. I mean, what does he know about annuity? Like, he's a credit card guy, right? I'm not saying it's wrong, but what I'm saying is, do they know about this? Are they licensed to talk about this, right? So I have no reason to support this if I don't know this, right? Now, uh, there are many types of annuities. As I also said, variable annuities will have heavy fees. So when we are generalizing in the one article, they say, hey, annuities are bad and annuities have fees. They're right. They're right. Annuities have fees. But my question is, which type of annuities? Do you even know there are 50 different types of annuities? Which index you're talking about, right? So yes, there are no, in this one, I'm going to show you no fees. But there are some annuities, the bad ones, real bad ones. Also, you mentioned about the lock-in period, right? I'll also show you the lock-in period is always going to be there. But you can distribute the money as you like. Obviously, there are ways to distribute it. There's a 10%, up to 10% you can distribute it. Now, if you have IRA, for example, can you take the money out from IRA? You cannot, right? I mean, that's the IRS limitation, not annuity limitation. So you have to pay penalty and all those things, unless you're 59. Now, obviously, I'll also tell you the caveat and some of the reasons why you don't want it. That's why you don't want to put all your money into one asset class. But we're going to compare here, right? So let's compare here. Uh, so I have my screen Excel file here. And on the left side, it's not about annuity. On the left side, I'm going to have anything you want to put here, right? So it could be a current IRA, your 401k, your brokerage account, your bank account, whatever you want to call it. This is your account, right? This is the left side is all you, right? And let's say you're making, some people are making good 8% right now, right? The market is, again, I'm not putting a single minus. This is the stock market. So let's assume this is the IRA, okay, traditional IRA. Okay, so we are making or Roth IRA, whatever. You're making 8% right now, and then, as you get older, Somebody's 45 years old, have 100,000, then he makes 7% as he gets older. As we get older, we will be little conservative and we'll say we'll make 6% for rest of our life. Okay. And again, I'm smoothing it out because, on an average, uh, I mean, you'll be lucky if you can get all of this return without a single minus. But I'm just saying, okay, let's smooth out because some year you will make 10%, some year will make 20%, some year you will make, minus 10. So on an average, I'm doing this, and we will change this. If you guys don't agree, you can always change this. I just want to go with the target funding example, which is how it works. All right, so 100,000 become 376. Say 400,000. Okay, that's a good example. So that's somebody's 45 at 65. 20 years later, it will become 4 times the money, right? 100 will become 400,000. That's a good growth without taking any risk or little bit of risk. As I said, income is the key, right? So now I'm going to add a amortization formula, or in Excel, you can see payment formula. What that means is it says if my 376,000 still sitting at 6% and earning 6%, how much can I withdraw for next 20 years? Because we're going to assume that we're going to live for 20 years. So I can take $32,000 every year, 32,786, say 33 every year, and I'll live till 85. So I have taken 655 out. So 100,000 invested gives me back 655. I mean, whatever. There's no problem with this, right? You can also make more if you have a higher rate of return, right? And I'll come back and change this rate of return for those who don't agree. But I think this is very aggressive. I mean, people don't even make 7-8% historically speaking. Not talking about the exception 1%, 2%. But let's say 100 becomes 655. There's no problem. If you look at the only problem is 86, this fund will become zero. If this was the only fund you had, then we have a problem. Not only we have a problem at 86, but actually the problem will start a little bit sooner because now at somewhere here you will realize that it will going to become zero. You'll realize that my fund, whatever 376 has become half. So it is going to get zero. So this is where your stress will come in. So again, the retirement money should be buying happiness, and it is not going to buy because money will become a stress. So this is the problem in the retirement years for those who see this is coming. Will be a problem. So this is the only problem I see on the left side. Obviously, you have to pay taxes or not pay taxes if this is Roth IRA, no taxes, right? Now, what I'm going to do, I'm going to compare this line by line, so you guys can see. So again, as I said, there's a growth annuity. So I'm going to first show you the 100,000 immediately, and opposite of Nari, what you said. Not only they don't have fees, but they're going to give you 15% bonus on the year one. It's opposite of, again, as I said, not every annuity is equal. And I will show you some of the annuities which are horrible also. But this annuity will give you 15% bonus, and it's index strategy, no fees there. So again, it starts growing. We'll come back to this one. But what is the condition? Your 100,000 is always guaranteed. So you see minimum guarantee contract value, minimum guarantee value. So at 65, no matter what happens in the stock market, your 136 is guaranteed. You don't want to look at this right now. Let's focus on the accumulation value. It also becomes $1.2 million. And I will show you how they became 1.2 versus 376, right? Is there any magic? No, I'll show you how they are able to do that in a second. But what I'm doing, I'm taking 100,000 each year from here up to 85. And it's supposed to have a formula here. So let me fix this. So simple formula, right? So we are say $2 million plus some money still there. I mean, you see account value, you still have this money left. It did not become zero. Don't worry about, oh, look at the 7 million is too good to be true and all that. Just understand the concept. That money continues to come at 86, 87, 88, 90, 95, however long you look, multi-million dollars, right? Even if you think this is not true, I'll show you in a second that it is proven that it's giving this kind of rate of return. If you're on the left side, you make everything like say 10%. Okay, you still can't beat it, right? So it's not about the grade, as I said, it's about the distribution, right? So if you see that, it's still, I mean, it's $1 million on the left side also, but you're not going to be able to beat this. Because on, again, left side, if you have 10%, then once in a while you also have like minus 20%. So it will become the same it will smooth out to become the same, what I showed earlier. So anyway, so now if I have to remove the risk, and if this is my way of return, and not only it's growing faster, but also distributing better because I do not have my assets going down. So I will not have that last 10, 15 years of stress once I retire. Now you can, this is a growth entity. So you can decide to take entire $1.2 million and do whatever you want to do. I'm just using example of distributing $100,000. That's my example, right? So it can last till however long. You can take the entire 1 million, or you can take a half a million, or you can do whatever. Nari, to your question, if you see here, account value continues to grow. Yes, there is a cash surrender period, and they purposely don't. So your account value is not blocked for any reason. You can take up to 10% every year from here, no penalty. But they are selling this at a loss to you. So for them to recover, it takes 4 to 5 years to at least get that, right? Now, this is a PE15. That means on 15th year, it'll become same. Both of them are same, right? But there are 7 years also available. There are 10 years. So you can decide to go 7 year, 5 year also available, 3 years also available. So if you don't like this, go with a shorter year locking period. But there's going to be some locking for no reason, for same reason. I'll tell you why there'll be a locking. Two reasons. Most of you, we've been following the news, what happened to SVB Bank a couple of years ago or last year. So people invest money so when you invest money in the bank, right, there's something called CRR, cash reservation. Donald Trump actually removed the cash reserve, it became zero. So banks not supposed to keep any money in the bank and they can invest all the money. And that was because of the COVID. It kind of was correct way to do it. It's still 0%, right? So they're supposed to keep that money, in the bank, but anyway, it was 10% earlier, so now it's zero. And they were investing into bond. What happens in the bond market? You invested, say that time, again, we are talking about 2019, 2018, we were getting 1% in a bank CD, or if you're lucky, 2% for 5 year CD. So let's say we got a 5 year CD with the bank and they were giving us a 2%. What are they doing? They're investing it further somewhere for a 3% rate of return. What happened after 2 years? Interest rates started going up. Jeremy Powell started raising the interest rate. Now the treasury is giving 5% interest. So your bank CD, which you have for 5 years, you're in the year three. What will happen? Year three, you say, well, I don't want to keep my CD because it's only giving me 2%. So a lot of people took money out from the bank CDs and put it into treasuries, which was ICD's bond was giving 9%, the treasuries 5%, and all of the other bonds were giving high rate, right? What is the penalty in the bank CD? 3 months of interest. So I said, we all said, that's fine. 3 months interest, nothing. Let's take the penalty and give it to it. We did not get bothered by the penalty there. And what does bank have? What happened to the bank? Now they can, because they've invested all the money at a bond rate, which is 3%. Because the interest went up, the prices have gone down. You are asking your money from the bank. Bank can't sell it because if they sold it, the assets are 50% down. So anyway, that's why they went to bankruptcy, right? Okay. Same thing cannot happen with this big kind of annuity companies. So what they do, they protect that. It's not they want to make money. But what if you say, I want all my money back the second year? They don't want, they're like banks. I mean, if you see in 2008, how many banks filed bankruptcy? 400 banks. 100 did not even come back. I mean, even the biggest banks like, Lehman Brothers and Bear Stearns, they did not come back, right? How many annuities companies died in 2008? None. Only one company had problem, AIG, which was some kind of a mortgage insurances they had, credit swaps and all that. So anyway, what I'm trying to say, they have to protect their assets. So that's why they don't allow you to take all the money out, not because they want to make money. It's just because the investment they are doing is for longer term. They are buying the bonds. Without bonds, they cannot give you guarantee. And if you guys are interested, I'll show you how they are making money. Also, I mean, how you are making money in the index strategy. Anyway, so that's why they buy the bond. But if you look at here, third year or fourth year, I mean, your 100,000. So again, now to your question, your 100,000 became 143 here. Yes, it's not 189, it's 143. Okay, take 143, still 40% up. Yeah, so what? So what? I mean, yeah. But if you can hold it for a few years and you see it doubles every 5, 6 years. It doubles. So yes, this is bad for if you're going to just if you just have a cash for 1 or 2 year, don't do this. But if you're going to do it for a little longer, if you can hold it for 5 years, this is a good strategy. Now this is for PE15, which is a performance elite product name, 15 year. There's also 10, there's also 7, there's also 5.
So
So
is
I can
this
show you.
example based on S&P growth, or
Yeah,
what is the
I'm going to come to
okay.
that. I'm going to come to that. So now I'm going to show you. I'm going to show you quickly the illustration. So here, so again this is the growth entity. I'm just talking the growth entity. Then I explain the income entity also. There's also income entity. So first, let's look at this again. This is the company's name, Athene. I'm a broker, so I work with like 30, 40 companies. So this is by far the best product out there right now on the fixed index strategies. So first page of the illustration itself is the word guarantee. And let's read the guarantee, right? So it says, you choose the certain fixed interest, blah, blah, blah. But then it says your annuity will always have minimum guarantee contract value. Growth potential is there because we are linking with
Vikram,
some kind of
upstairs.
index. Now, I'll show you indexes also. There's also premium bonus, as I said in this one, 15% bonus. Protection, there is no direct downside market risk to to your money, and there are tax deferral, right? So, sorry, somebody was saying something.
No.
So continue. So now, question, right? So if you see, these are the different types of indexes. You can pick one, you can pick all of them, and again, there are no charges. So AIGO is the actually global artificial intelligence. It's basically moves the assets between bond and you know different asset classes, cash or stocks based on the volatility. This is the US equity AI. Okay, so again we have 10% allocated there, 5% allocated here. This is BNP Paribas. It's again BNP Paribas is the total market including bonds and stocks, right? It's a little bit think of it as Russell 10,000, right? This is Nasdaq. So we have also 7.5 allocated there, and then S&P 500, which is what Nari use. You can also put entire 100% here. I'm just using a preset method, which is called balanced, because I like the balanced strategies. And then if you see, this was 2 year point to point. So what they do, they compare the price today, they compare the price after 2 years, and if the market has gone up, you get that much money. If market has gone down, you don't lose money. You got it? So I'm not able to draw it on the screen because my tools are not working. But think of point A and 2 years from now, point B, and whatever the difference, whether it's S&P 500 or Nasdaq or whatever that index is, whatever the difference, the percentage you will get. If the percentage is higher, you'll get higher percentage. If percentage is lower, you will not lose anything because the lower means floor will hit. Okay, there is no cap. So I'm now removing the cap also. Remember the green line, I keep saying 13% cap. So let's not talk about cap. There is no cap here. On top of that, if you look at the participation, this is my favorite. So let's say today market is 100. 2 years from now or 1 year, there's also 1 year. So 1 year also here. So same AIGO, AIPEX, BNP Paribas, NASDAQ, S&P 500. This is UBS Innovative Index, right? So same five indexes, we're taking 50% into 1 year, 50% in 2 year, right? So let's say 1 year, whatever, or 2 year, whatever the market is today, 2 years from now, whatever the market is, today is 100, let's say market is 110, 2 years from now. That's a 10% growth, right? Look at, for example, BNP Paribas. How much you will get? 10% multiplied by 250%. So you will get 25%. So now you're getting more than the market return. So if market is 10, you'll make 25. Market is 20, you'll make 50, and so on and so forth. If you look at the S&P 500, the market is 10, you will make 11. So now you're actually getting 1% more than actual market performance, right? So you're beating market in the growth and you're not taking risk. So this is why this is a crazy thing out there, right? And I'll show you the mechanics how they're doing it. It's not like they're doing something, they're not even investing in the stock market. As I say, they're buying bonds, 95% of the money, 5% they're buying the leap options to do this. Okay. And if you see NASDAQ also, 160%. Now, NASDAQ, a lot of people like NASDAQ, QQQ, everybody's favorite. So imagine if QQQ went up 10% or 20% or 30% or 40%, whatever, right? Multiply that. So this is your multiplier. In 1 year, except this guy, S&P 500, everything is above 100%. In 1 year, S&P 500 goes 10%, you're going to make 8.2, right? That's why we have a smaller percentage, but others are still going to perform higher. Now we can also say, I don't want this. We can meet every year and we can change this allocation every year, like you can do it in a 401k. Right? All right, so this is where it now, as I said, the first so this is an example of 45-year-old male, $100,000. You can see the first year itself, the first day itself, he gets 15% bonus. So this 15% bonus, even if you had that 2 or 3 year or 5 years of lock-in, the 15% bonus gives you like if you're making 7 or 8% every year, it gives you 2 years of jump start. So a lot of people, let's say those who have lost money, think of this as a recouping some of the losses. This might be a good time also because market is kind of all-time high. Going up from here or going down from here, probabilities staying here is higher or going down is a little bit higher. Going up to like 6,000 or 7,000 is, again, it can happen, but the probability is. So if you believe that, if you're bullish and you think market is going to go up big time from here, fine. This will give you 110%. Whatever market performs, add 10% to top of it. If you are sideways, like I am, I believe this is perfect because sideways market will also perform better because the market, it goes up, you make money. Market goes down, you don't lose money. So you saw Mr. A, Mr. B, sideways market, right? And if you think you're bearish, if you think market is already high, then so then take all the profit, take the 15% bonus, and don't go down. Period. And like somebody was explaining before we joined, that it's good strategy to understand the market and take the money out when you think everybody's every your postman or your post you know girl comes and say, okay, I want to buy these stocks, and that's a time to quit. So this is a good time to quit. But the problem we have, I had always problem. Like I've been investing since I was in 12th grade. 12th grade. One of the problem when we say take out the money from the market, we always think if we take out money from market, that means keep in cash. No, you take out money from the market and you keep it in here. So you're always participating automatically. When the market goes up, you go. Market goes down, automatically parks on the side. That's how it is. Okay, so that's the formula. Now I want to show you some of the simulation done.
Andy.
If you hmm?
Hi, Andy. This is Gopi.
Hey Gopi, how are you?
If you can just go back to that previous slide regarding the participation rate.
Yeah.
Yeah, so essentially, I mean, here you have numbers above 100%. Like, how does a teen, I mean, if you've given them 100,000, they're investing that 100,000. And like, if your participation rate is 180%, then, where do they get that additional, 80,000 for them to invest in, for them to give you that return?
Yeah, it's an excellent question. Actually, I actually have a example here. So this is how they do it. As I was saying, how are they actually making money? I mean, same market. How are they making 10% or 50% extra, right? So what they do. So think of the $1,000 example, right? So they take $1,000. Let's say you invest 1,000. They take 950. So remember banks, as I was saying, CRR, the cash reserve ratio, which was 10% and now is zero. The annuities companies have a CRR of 65. Not CRR, they're called legal reserve. They're 65%. They can't use the word guarantee. The federal and the regulators will come after them if they can't. So they have to invest 65%. They have to keep that money in a safer investment. Some of the good companies, they're investing 95% of the money in the legal reserve. So this is a legal reserve fund, typically always stays in a bond, the safer bonds. Now they're investing, remember, billions of dollars, right? I'll show you to every quarter, like double-digit billions, like 20, 30 billion dollars, right? So when they're buying the bond, they get 6%, 7%, let's say 6%. So what is the 6% of $950? $57. So the net result at the end of the year would be 1,007. The remaining $50 or 5%, they'll buy the leap options. They're not buying stocks, right? And those who do options know that options are leveraged. So depending on how the market conditions, they can make ton of money. So if say for example here market goes 10%, the leap option can triple. They can buy 3 options for $50 for that index. It could be S&P 500, Nasdaq. So in this case, I'm illustrating that if market goes 10%, they're going to make 15%. And because of the 5%, if you think market is going to make 10, they're going to make 10%, they can also give you 10. So now 1007 plus $150 from the options will give you 15.70. Right? If market goes 20, you're going to get 30. Right? What if market goes like 1%? So anyway, whichever percentage you'll put. But what about market goes minus 20? This is the flow. So what happens in that case? Your bond is still protected. It'll still give you 1,007. The $50 they invested in the leap option will expire worthless. So now they will get zero. And your flow, so your flow is always intact. That's how they are protecting. They're not some mutual funds or some kind of an investment where they can promise you anything. This is how the fund. So basically what they're doing, they're using the hedging with the bond to maximize the growth. Okay, and if they can't maximize it, they'll give you zero. Now, why would they give you zero? Because market did not perform. In that case, you'll be losing in the if you were naked, right? If you were unlimited, like unprotected in the market. In this case, they're protecting with your bonds. And this is the reason, right, Nari, to your question also, when they're buying the leap option, they're buying like 2, 3, 4 years advanced leap option. So if you want that money sooner, they have to sell the leap option. At that time, they could be taking losses. Also, the bond could be 4, 5 years long bonds. And that's why they don't want to be like SVB banks and other banks. So does that answer the question, Gopiji?
Yeah. So the number that the numbers that you have provided there, like, does that remain constant through the life of the annuity?
So numbers, the 0% floor always constant.
No,
The
not
growth,
the
the growth numbers,
participation rate.
the participation rate can also change because, like I said, what if right now the call options are very expensive at this stage? But what if market becomes bearish? The call options are going to be cheaper. So participation rate will also change. However, they always have a guaranteed contract value. The floor will never change. The guaranteed contract value will never change. So those are the guaranteed. Now participation rate will change. But why would they change? So let's understand why would they change. They will change because stock market has crashed.
Mm-hmm.
So if the market has crashed, and let's say they were giving 200% participation, right? And now they change it to say 180. Do we really care? We don't care. Why? Because the market has crashed anyway. Whether they give 200 or whether they give you 180, who cares? Because we are going to get zero anyway. Because the floor is going to hit, right? Even if they reduce they increase the participation to 250, it's still not a good news because market is negative. So then we're going to get zero. So that's what they guarantee. Now participation rate historically have been changing especially last 1 year they've gone up. And if you, I'm going to go back to this one. So here you see participation. I've seen 30 to 40% up and down. I'm not seeing like the 200 will not become zero or it will not become 10 or 15. Like they have been consistently in that. So I've been doing this since 2015. I'm not seeing in the 20 or 30 points range it moves.
So
But yours are locked. Once you get this 2 year, then they cannot change participation for 2 years. After 2 years, whatever the market conditions, they will change it. Now, as I said, historically, the participations are changing because the market has been not performing well, or it's a bond market has crashed, or something must have happened. In that case, anyway, you don't care about participation because a point to point you're going to give zero. So I just want to ask, because we're going over, is it okay to stay another 15 to 20 minutes because so I can cover this?
Yeah,
Nari,
yeah,
is it okay?
yeah. Go ahead.
Okay. So I'm speaking a little fast also, but I'll share my numbers for anybody who wants to talk offline also and look at more details, right? So these are if you look at here, for example, right? If you look at again 2 year, we have 2 year, and we have so again, Nari, to your question, you see here, these are the 5 indexes with charges, and these are the 5 indexes, the same indexes without charges. What did I pick? No charges. Why should we pick charges where without charges also is doing amazing? So again, there's a reason why there are charges, but I'll explain that in a second. So let's pick this, right? So 5,845 scenarios. What they've done, they run the point to point 2 year 5,845 times, different years. And if you see percentage of scenarios with gain, look at BNP Paribas or look at AIPEX, right? Or look at AI Go, right? So if you see 94% of the time, it gave something. For probability of zero interest credit, that means, market must have gone down. Only 6 times out of 100, BNP Paribas gave zero. I mean, it will never be below zero. We know that. Nasdaq, obviously, we all know it's super volatile. So 27 times it gave zero. 73 S&P 500 15 times, and UBS, it's a new index, it's a 1%, right? If you look at the best 2 year performances, here all your performances. If you look at Nasdaq, for example, 81%. Look at BNP Paribas, 67. So it's not like, hey, you're taking less risk, so you'll get less gain. You're still doing, look at average 10, 11, 11, 10, 50. So that's the average for last so many scenarios. Is it guaranteed for next year? No, but that has been so many data they've compiled for over 100 years. And this is what the back testing shows. I'll also show you again, here. Now, again, to Gopij's question also, what is guaranteed, right? So I'm now going to show you guys um, a, a worst of the worst of the worst, right? So let's say we invest 100,000. Remember the 15% bonus they give. So 100 will become 115,000. That's a 15,000 bonus. Okay, that's easy. But what if market goes from here negative every year for rest of our life? Can that happen practically? Probably no. Obviously no. But in theory, it can happen. So we want to now look at the guarantee aspect of it, right? So now we are saying that you always get zero, which has never happened. But let's say you always get zero. World War III starts, pandemic comes back, and the world comes to end or whatever, right? So that 100,000. Look at this column, minimum contract guarantee, and again, 45 at 65, he will still have $136,000 guaranteed. Where if you had this money in IRA or 401k, it would have been disaster, right? So I mean, some of the banks will disappear also. So at least this is a guarantee aspect. It's not a lot, but as I say, this is your principal and the money. I mean, they're still giving you some percentage, which is compounding a little bit. And remember, the 15,000 also keeps growing. That's the worst case scenario. It doesn't get worse than this. Now, what if market does what it has done in last 20, 30, 40 years? So in that case, same thing. I'm using it here. So now we are using that fact. So some you'll get 8%, some 11, some 9, some 23. How is the growth coming? If you see here again, I'm going up. If you see here, we are picking the balance index. So some are one year point to point, some are 2 year point to point. So 1 year point to point has less participation because it's a 1 year. 2 year has more participation. Simple. So let's say S&P 500 gives me 8% this year. The next year, this will also give me 8%, and this will also give me like whatever 11%. So on the average, you will continue to get something every year. Now, some year you might get zero because say all the market crashed, right? Like COVID. So if you see here, going down again here. So 8%, 11%, 23, like see this zero here, and you see one more zero here, right? So zero is good, but you will not see a single minus. And that's how in my Excel I was showing you guys, that's 1.2. If you think this is too much, assume everything half. So if we go back to my Excel and we say, you know what, that's too high, let's be conservative. Okay, that's fine. Be conservative. And we assume, say here, I'm assuming 10% and you were making 1.5. Let's assume everything half. It's still going to beat your 10% rate of return, and you're not taking risk, and the money doesn't run out on you. So that is the one type of annuity. Okay, and as I said, I'll share my numbers so you guys can know. I want to show you another type of annuity. This is income annuity. And again, if somebody has a problem with 15-year, we can get the lower also, lower years, like as I said, 7, 10, whatever your appetite, right? So there is income annuity. This is also called pension annuity. So this one was our 401k type annuity where you can distribute however you want. In the left side, I was distributing 100,000 because I thought that's good enough. You're investing 100, you're getting 100 for the rest of your life. That's a good way of saying. Let's simplify. On the right side, there is basically this one, Athene Agility 10. Again, it's a 10-year lock-in is there. But as I said, for distributing income, there's no lock. But if you want to close and you want to go all money out, then there's a lock, right? So in this case, they do two things. So I'll explain in the PDF file itself, so you'll see it a little better. So same Athene Agility, you see the guarantees and income. Now in this one, they have one thing which is very special. You can receive a guaranteed retirement check, paycheck. Whenever you are ready, you can create a stream of income that may grow throughout your retirement years. So it does not matter how long you live. So Nari, to your question also, you'll see here, no charges. And now this one has another protection, which is a guaranteed lifetime retirement income. Okay, so again, same indexes or similar indexes, no charges, obviously. So I want to explain a little bit here. So again, if you see participation in the same range, little bit lesser participation compared to performance elite or the growth annuity, because that was a growth plan. This is income plan. What they do, so this is what the account value will grow like this. But they also maintain two accounts. One is account value, which is your account, and the other one is called benefit base. That's a pension base. What they are going to do, the first year they're going to add 20,000, which is a 20% bonus to the pension base. Okay, and then every year. So let's say market goes 10%. BNP Paribas, for example, or say S&P 500 goes 10%, how much are you going to make? 9. Right? Simple, right? Market goes 10%, S&P 500, you're going to make 9% because of the 90% participation. Multiply that by 200%. This is what you'll get. So your account value will get 9. Your benefit base, pension base will get 18% because of the 200%. Now, this will not change throughout the life. This will not, and then likewise. So now I want to show you again some of the examples here. So you saw this again, you guys know this now. Let me now show you the worst of the worst. Okay, so again, worst of the worst, market goes haywire from here, never comes back. Your 100,000 has 120, and if you see your contract guarantee still 136, and let's say you retire at 65, you're guaranteed to get, even if market crashes from here for every year, no matter what, you're guaranteed to get 5,820 for the rest of your life, as long as you live, even after your fund has become zero. So if you see here, your account value in a benefit base, as I was saying, the account value is your fund, benefit base is the pension fund, right? Both have become zero, but your 5,820 will never stop. Right? So that's a guarantee aspect. Okay, it's not a lot, but as I said, we are not shooting for this. This is the showing that how much guarantee is there, right? But can we get growth with the guarantee? Absolutely. So now if you see here, I'm going to use the same. Again, I'm going with a very conservative 8.2, which is in the market is done much better. But we're going with 8.2, which is, remember, the participation is almost double. So we're assuming the market will do 5%. So if we double the participation, it's going to be 8.2. I'm going super conservative here. So your 100,000 will become 120. So again, benefit base, that's your pension account. That will become at 65. It can be at 60. You can retire anytime. I'm just saying that will be a close to $1 million. So say $900,000, right? So that's 9 times the money. Your 100,000 became 900 here. Look at your account value also grew to become full for 456 or 496, right? Now here you have two choices. Either you can take a pension for rest of your life. That means you're saying, I don't care about account value and give me the pension, which is a 4.5% guaranteed from the benefit base for rest of your life. Or you can say, no, I don't care about the pension. Just give me my 496K and I won't do whatever, right? So now if let's say we pick the pension plan. So now you're going to get 44,000 first year. Now remember every year, now forget about what's happening in here, right? But let's say market went up and you get 44 or 52, 53, 61. So let's say market continues to go and you make 72. So once they give you 72, 931, from here onwards, they will never go down. The 72 is always guaranteed. If you go earlier, once they give you 44, 957, that's your guarantee. From here onwards, whatever happens in the market, Your 44,957 will never go down. That's your pension. So pension will stay as it is or will go up. In some year when the market has performed zero, negative, you'll get zero. That year the pension will not go up. It will stay for 957. The market has gone up. Again, we are assuming 8% here. Then you'll make 52,000 next year. So likewise, you can continue to, again, here you're making 87,000. That's locked in. Once you get 87, you will never go below 87. For the rest of your life, you'll get 87 or more. Now, let's say here, I'll use my example. What if I die? 87K I was getting, I die. Then what will happen? My wife can continue to get 87, 102, whatever all this mentioned, my wife can continue to get the same money as if it was her annuity, right? So this is the annuity feature of income annuity. You see here, let's say my wife is 78 and she's getting 121, but my benefit base has become zero. My account value has become zero. I've already taken $1 million out. No matter how long she lives, this money will not stop. Obviously, once she dies, this will stop. Is that a question? Sorry, I do not understand. Is somebody trying to question?
Yeah, I think there was a crosstalk. I muted them.
Okay, thank you. So just example here, if there's a money here or there's no money here, the lifetime income retirement. So again, this is the pension. So if you now compare this with your left side, and again, you can put whatever percentage on the left side you're comfortable. I usually put 8 and 7 as my target because that's what the market has done. So here, if you like the dollar, if you understand the numbers game, then it's a 1.5 versus ton of millions. Even if you want to assume 3 million, it's good enough. And if you see on the annuity, the income annuity is also 2 million. It's not less growth. But the good thing is, if you die, so it protects two family members, husband and wife both, and the income will never stop. So now, if for
Andy, I
those
have a
people who are,
question.
for 1 second.
So-
So those people who are in the 60s and they are looking for
Yeah, I
retirement
think there is a
income.
question, Andy.
Okay,
Go ahead.
Yeah,
sorry.
Andy, if it's great, everything is interesting, but the underlying company, in worst case scenarios, what is the guarantee that it won't bankrupt? And is there any FDIC kind of insurance for the amount?
Yeah. So as you know, annuities and insurance companies don't go by the FDIC insurance. They have a state guarantee fund. So, and if you really see banks or Fidelity or Charles Schwab, they can't even use the word guarantee, but these companies are using guarantees. So what that means, there are 3 levels of protection, right? A, they have to put that 67% in the legal reserve, and these companies are putting 95%, right? But let me show you, that's a good question. B, you can see let me show you the couple of things here quickly. The rating, if you understand the AAA, AA, those kind of bond rating, so there's a company rating also. So if you trust the ratings, you can see they're actually very highly rated company. Athene has been there for 100 plus years, right? And the one other thing I like to do is the balance sheet. Look at the balance sheet. So if you look at really, again, you can Google and you can get the 10K and 13K. But if you see they have a $235 billion asset and the $213 billion liabilities. So the net, they still have on the balance sheet, the net worth is still 20 billion, the net, right? So that means the chances of them going bankrupt is negligible, right? And these are the way I can show you this. So this is plus all the annuities, insurance companies, they're supposed to keep some money with the state guarantee fund. So when they go bankrupt or they about to go bankrupt, the state will come and rescue them. Like I said, it's guaranteed. That's why the word guarantee comes in, right? Other than this, I can also show you one thing which I like to,
Is
as I
this
said,
firm is federally registered in some kind of a federal institute, and is it regulated?
they are these are insurance companies. They are more regulated than banks and the fidelities. They are more regulation. They're regulated by federal. They're regulated by state. Every state they operate. So, for example, New York doesn't have this company. This company because New York also have something weird thing. So yeah, every state, everything, and on top of that, there's also insurance and the annuity governing body which also protects them, right? So yeah, they are basically they have to disclose everything they're investing on. More regulation than you can imagine.
Andy, a quick
Uh,
question. Why majority of these insurance companies and products are not available in California and New York?
this is available in California.
It's
It's not
available in California.
majority of
Why not
it's
New
not
York?
New York because New York State has a restriction because again, it's a politics, right? So they have it's not they're not available. If you go with what is it called? What is it called? Life on your side, Nationwide. Nationwide is providing the same product. New York, it's different product, different company. So Nationwide is maybe New York's, I don't know, some kind of affiliation. So that they have a different rule. California again, California, most of the company operates, but California has a different requirement for the producers. Like those who want to do business, they want 8-hour training, some 16-hour training.
Oh, okay.
So people who wants to operate, they don't like to operate in a, where they have to put more efforts. But as I said, I am licensed in New York, California. I'm licensed in 40 plus states. I have clients in New York and California, and Washington is also now becoming that state. Washington is also adopting California, but that's fine.
Andy,
That's how it works.
Andy, another quick thing. I put a question up there in the chat. Can you please share your contact information there, please, in the chat?
I've hold 1 second. I'm not able to type. That's my problem with my tools are not working, but I'll definitely share in a second. You can.
Yeah, I will. Yeah, I can share it in the group later on.
Thank you, Andy.
Yeah, I'm also on the group, so
Oh, you're
I'll
on
just
the
say, hey,
group.
this
Okay,
is
great.
Andy.
Awesome. Thank you. That's good enough.
Yeah, yeah. But I'll share that. Okay, let me continue because we are running over and I want to respect every and some of you are East Coast, so I'm sorry for that. So one thing, it's a very excellent question. So I showed you 2 level of protection, but I'm going to show you facts. Okay, because I'm sure you guys all have seen this, but I'm trying to bring a new perspective. So here, I want all of you to search in Google Limra. I'll post this in a WhatsApp. Limra. Limra is a central authority. Think of this like Equifax. Yeah. So what they do, they collect all the data for the annuities and life insurances and all kinds of insurances, right? And if you just read some of the articles, and you can Google it, Limra's, right? So if you see some of the things I'm saying, I don't want to read all of them, but if you really see here, fixed index annuities, right? So again, this is 2023, FISAs were 22 billion, up 5%, 23% gained market share, right? So deferred, again, there's a income annuities and all those things. But I want to show you guys a, 1 second, my tools are coming. I want to show you the actual facts. So again, this is the index, those who say, why this was not there. It is picking up. Traditional variable, if you see in fourth quarter of last year, it -3% and year over year is -70. The variable, which is the fee based and the market risk and all that, index has gone up. Okay, I want to show you the top companies. And as I said, I'm a broker, I'm a CFP, so I can work with any companies. I'm actually independent. I'm not affiliated with Athene also. Tomorrow, FNG gives a better product, I'll go with FNG. So here, I want to show you here a total annuity. Again, this is a total annuity sale. This is the data. You can search it on Limra. Third quarter of 2023, you can search any year, any quarter. This is total, this is variable, and this is fixed. Look at the fixed, or look at the first total. Look at Athene, $22 billion in 1 quarter, themselves alone. This is AIG. This is Mass Mutual. I mean, again, these are the best of the, New York Life. It's probably safer than government, right? Who's going to, even that is not beating it. So why we need Athene is because they have some good features at this stage. Tomorrow, if New York Life comes, then we'll go with that. Allianz, I mean, those who know, Allianz has been there for 120 years. You mentioned about the National Life Group. So if you want New York, you go with National Life Group. It's also very good. They also very good entities. You have this Pacific Life. California has all this. California has most of this now. So anyway, this is the reason. If you look in the fixed category, if I know that this is the #1 product and asset class, I'm not saying take all your money and put it in here. Think how you can diversify now with this knowledge. You can work with anybody, or I'll share my numbers nationwide also here, by the way. So you see all of the top 20s. Now, why they're top 20? Because they are the safest and by far have the better strategies. and they are basically maximizing the growth for so many years. I have annuities, my personal annuities. If somebody want to see my growth, I have it for 15 years. I can show you my own statement just for you guys to be, at least satisfied on this topic. But you can always Google it and see how a thing is doing. So with that said, I think I have shown everything. But I will also keep it on the screen if somebody wants to.
So, Andy, I have maybe a couple of more questions. One thing is, I've done this with a friend in New York Life. So I think locking period is 10 or something. Whenever I contribute monthly, I'm contributing some amount. Some portion of the money is going to my agent, my friend. That's one thing. And in the initial amount also, I think some amount went. So question is, I think, how are you getting paid out of it? It sounds like it's a monthly every time.
Right. So
Yeah.
So there are multiple. Is he an insurance agent or a CFP? Like I'm a planner. I'm a financial planner. Insurance is not the only way I get money. The commission is not the only way I get money, right? But yeah, and again, the monthly means you are. I think that's a weird type of annuity if you're paying monthly. Is it an annuity or a whole life insurance you're talking about?
It's a whole life insurance. Yeah.
Yeah. So I did not cover whole life today, but reach out to me. This is my phone number. I can tell you why it's a bad or good or after looking in. But I can help you. I have a ton of example to show on the someday maybe if Nari ask me, I'll come and present whole life RU and all those things. There's a lot of myth and wrong information, some good, some ugly, But yeah, whole life also, if you do not understand it, and I'm not saying you or a friend, but yeah, that's how they make the commission. Insurance agents make the commission. Here, I'm not making commission because you're not paying every year. There's a certain percentage given when you roll over, and that's how the money will come. And I'll share that with you also if you.
Thank you.
So this is good for IRAs, traditional IRAs, Roth IRAs, previous 401k money, or if you have a cash which you don't need it for another 5 to 6 years. Don't put money here if you need it again in next year. Then don't put it here. The insurances will cover in some other time, whole life. That is a different type of strategies. They're also good, bad, and ugly. And we'll cover that in some separate section.
Hey, can I ask you a question?
Yes, please.
So you said like right now, if let's say somebody starting into annuity and Athene has a better product, has the best product, invest with Athene. Few months later, let's say nationwide launch something better than that, and that comes on the top. Can you switch it? Like, are you saying you can switch from every six, like you can switch around your investments?
You can, but it's not required because, let's say you have 4 good indexes in Athene. Right now, I like their AI indexes, which are performing exceptionally well. It's like really they do auto balancing also. And let's say nationwide comes with it 6 months later. Now, you don't need to switch because you already have those features. Athene already has those features. So once you get the feature, they're not going to take it back from you, right? And when I say some other company comes, like let's say they will give you 30% bonus, but you already capitalize on that. So you don't need to switch it. Technically you can, but you need to know the limitation. If you switch it, then you get the cash value, not the account value. So don't switch it for less than 3 years.
What is
Then
the
don't
track
buy
record?
this.
So usually one of the parameter I look at before, let's say if I'm picking up a mutual fund, and if I can dare to compare this, let's say to a mutual fund, any mutual fund, is the history of how old that mutual fund is and how old the manager who's running the fund. What is the history track record of that fund? So like if let's say you're picking up Athene, how old are these funds? Like if you're picking this AI Athene fund, is this launched in the last 6 months? Is
AI launched last year, but S&P 500 has been there for so many years. BNP Paribas, okay, I think it's a really good. So I'll show you here. So you're gonna like this out. So let me show you in my file. I actually had this, but because we were running, so look at BNP Paribas, right? And this is a website. So I'll also, if you want, you can also type it. But anyway, I think I have somewhere. I was prepared for this meeting. So yeah, here. So I have a, if you want to look at the BNP Paribas, right? So yeah. And this is the index, actual index. And you can, if it comes in a second, you can also look at the performance. And I have done the modeling next to neck, like you were saying. So look at S&P 500 all the way from 2020, 2003 till now, right? BNP Paribas, we know it's a, and then you can read about index weightage and what they have and all that, you can research. But anyway, BNP Paribas is a balanced fund, right? Basically, not like I said. Some year it performs even when the market has gone down. 2008, 38%. S&P 500, BNP Paribas performed 3%. And likewise, right? So if you perform so less minuses, but overall the growth not very well. I mean, if you look at 24 versus 4. So what now? If I compare the same data and I put this in Excel, and I can share this Excel if anybody wants. So if you see here now, I'm basically copy pasting the same thing. There's no magic here. I've taken all of that and I highlighted the 4 rates, which is S&P 500. I just did $100 and compared. $100 gave 532, and if I just take the rate formula, which is my time value of money, it gave me 8.72 compounding. Now I'm taking raw BNP Paribas, which you saw on the website. It's only 570. That's no fun. So, but we are not getting this. We are getting, see, if I had 1 year point to point, then I'm getting 180% participation and 15% bonus. If I add those figures, it beats S&P 500. If I do 2 year, because I'm blending it, I'm actually doing laddering between 1 and 2, right? So if I did that, 11%. The same year, if you see minuses in reds here, you see blue compared to them, they're either zero, so never minus. So now, if I take 50% of this and 50% of this, can I safely assume that I'm making 10% without taking risk, beating 8%? Now, granted, you can also go up on the left side if market goes up from here. I'm not denying that. But why would you take a risk? And where is the distribution? How are you going to define the distribution? Distribution is still not in your hand. You still have to distribute. In a thin agility 10 that you saw the pension, you don't have a distribution risk. Once you distribute, continue to distribute. Now, if you go with charge option, which is 1.25% charge, which I did not show it to you guys because I wanted to keep it. But in there, you'll have a more participation. 1 year will be 235. You're buying, basically, it's not a charge for the fund, it's a charge to buy more participation. So, person like you or me, we might want to take a little bit aggressive and look at there. Again, 11%, 12% ballpark, right? I mean, I have my annuities only 2%, 2 year. I don't like 1 year. I don't like to, because market back to back 2 years rarely goes down. Even in the 2020 did not go down. Even 2018 it did not go down back to back. Even 2022 was 1 year in recovery. So I like the 2 year back to back, and I get 11%. Why take a risk? Now, yes, I have say some money which I need for college. I'm not going to put it here. But my IRA money, which I'm not even checking, I beat S&P 500. So this is how the modeling is done. If you like, now I'm going to go further. Okay, let's take S&P 500, which is also giving 2% dividend. Right. So I've now taken from 99 till 2022. I've taken S&P 500 and I added the dividend yield also. And your $100 or your $1,000 became 3,953. If I put a cap, same now S&P 500. If I put a cap and I say, okay, put a cap in 12% cap at 0% floor, and if I get a 15% bonus, it's still $1,000 more. But in our strategy, we don't have a cap. What do we have? We have say, and I'm not even using the crazy 110%. I'm using just 90% participation. Purposely, I'm being conservative. 90% participation. So every time market performs, you make 90% of that participation. It's double the money, 4,000 versus 10,000, right? So it's a simple. Again, you guys can all take this and run your own. Somebody wants it to jumpstart, I can share this. Try to beat this. I'm sure some mutual funds or some bitcoins and cryptos will beat this, but you diversify, right? That's why you don't put all your eggs in one basket, and put some of them where you're okay to take risk. Some retirement money, I would not take the risk. I'll put it here. Okay. Any more questions?
Andy, what is the typical age group this is the best product for? Because if you're too old and you don't have enough time to get
There are for too old, again, too old is again a number, right? Age is just a number, but there are immediate income annuities also, which starts from like next day, right? So if you put the money, it starts from now, they are going to give you less return. So what we do, let me show you here. I don't know if I have it here, but they also have inside here the fixed also 4.5 guarantee. So and again, I'm going to answer that question. So you see 2 year here. There's also, which is not shown here, which is a fixed 1 year fixed, which is 4.5% guarantee, right? So if somebody's old, what I would do, I will ask them how much money you needed, because you don't need money. Let's say you have a $500,000, $1 million. You don't need all money today, right? So you would put it on a different tranche. So do you need some money 5 years later, 10 years later? So the percentage you need now or the next 5 years or 4 years, because market can go down next 4 years, 5 years, let's say worse. So what you need in 5 years, we'll put it in a fixed, which is 4.5 guarantee. What you need after 5 years and 10 years, we'll put it into the balance fund or a growth fund, and then we can, go further. And also we can also do this in the income annuity, which are actually, they're called immediate annuities. In immediate income means you put it today and you get it tomorrow, right? Those will be giving a less growth because you also distribute it. But typically age group anywhere from, I have clients anywhere from 30 till 80. And those who are younger, I would recommend put IRA and previous 401k, because people change jobs. So they have previous 401k that you can roll. But people who are old, after 80 anyway, I think it doesn't make sense because you don't have enough time. But yeah, even I have 72-year, 75-year-old. I work with a lot of teachers, especially the pension teachers, and they are 75-year-old. They supplement this with their social security. And again, I did not show you the immediate annuities. They're called immediate. You can put fixed there, fixed index there also.
Right.
So was this useful? Like, I don't want you to repeat some of the things you may have heard or researched, but if
It was
anybody
very
wants to
useful,
reach out
very
and say,
useful,
hey, this
Andy.
was good, but I've also researched. I'm a research person. I'm, as I said, we are all engineers, right? Background. So I like to figure out if there's anything doesn't work. But I have certain asset class I have stocks, I have cryptos, I have real estates, I have all the asset class, and I have this also. And this is really performing very well for the life goal I have.
Thank you, Andy. This is good. Can you hear me? Okay. So, can we do this for on the name of kids? Like, kids don't start early. So, I was just wondering if that is possible.
You don't want to do this, but as you can do Roth IRA, you can do, but there is a different way of doing kids. I do another session on how to build infinite banking or college funding using kids plan. I can show it to you, some other session, or reach out to me. There's a different way of doing kids. Actually works better than this one because kids are super young and they might need money for college or marriage or starting a business or buying a home. It works amazingly because you can't put it in here. Because once you put money here, you cannot touch it until 59 and a half. So this is
Got it.
not good for the kids. But
Got
there's a different way of doing this. Basically, what is the secret here? Is the infinite, that index strategy. Index strategy can sit in multiple asset classes. So
Got
we are
it.
putting into annuity for the growth. We can do the same thing for the college funding, using the college funding like 529 or whatever, right? So
Thank you.
So, what happens to the money balance when a person passes away?
so yeah, that's again good question. So multiple things happen. So let's say here, I'm going to use the growth plan, growth annuity. Oh, this is let me show you the growth one. So let's say I'll use my example. I'm 85, I pass this away. I'm 85, I die. And my wife is still living. So my wife has multiple options. She can either continue to get $800,000 and $100,000, or she can take the entire $5 million, whatever she wants to do. Okay, so that's my wife because spouses have a different tax treatments. But if my wife is also passes away, we both are gone at 85, then the $5 million, you can say death benefit. This is not a life insurance. Death benefit is nothing but your account value, basically, right? So what happened? Now kids will get it. Now, depending on the gap between your age and the kid's age, they can either withdraw it in 5 equal installments, 10 equal installments, or all the lump sum. They're forced under Secure 2.0. There's a new law came out. So Secure 2.0, they can take it out, but they have to take it out in 10 years. They have to take out. So then they have to pay taxes if you do not pay taxes. So, but the wife can continue to grow it. Even for the income annuity, the same treatment. Wife will continue to get the income. Once she passes away, if the money is there, kids will get it, or whoever you nominate. You can also nominate, or whatever your will or trust. It will go to your estate if you don't have the beneficiary. If you have the beneficiary, your beneficiary will get it.
Oh, okay.
And if it's a Roth IRA, nobody pays the taxes. If it's traditional IRA, everybody pays taxes. Right. So
Any
thanks
other
everyone. I
questions,
think
guys? I think this was useful. But I think if you do have any questions, you can email Andy. I think Andy is in our group as well. And Andy, maybe we can discuss, and you can conduct another session on some other related topics you mentioned. Yeah,
right.
but
No worries. I mean, just put it on the WhatsApp or best way. I have the green. That's a tinyurl.com. Meet me, Andy. That's the best way to remember. And my calendar is there. You can block time, right? Or you can just text me and we can work out sometimes. Okay, so reach out if you have any questions on this, or if you want to, again, now you can tell me. I don't want to sound like, I'm here to sell insurance, but my goal is to make sure you all are aware because there's a lot of information which is correct or incorrect. And again, Nari has been asking me to do this session, but unfortunately my schedule was tight. So now I can do a couple of more sessions. There's and also, as I said, if you have something like somebody mentioned New York Life and you want me to review it, I'll review it for free of, as I said, I know somebody, I'll get some help from some of you from on the crypto, right? I don't know anything about crypto, but so I will help you and, use my skills to help you on that free of cost. Don't worry about it, right? So, okay. So with that said, I'm going to stop sharing. Is that okay?
Thank you, Andy.